In this video, I will be looking at seasonality, days of the month patterns for the S&P 500. I will be explaining how I have calculated it and how you can use this information to improve your own trading. Hello, this is Mark from TradeInformed.com and welcome to this video on how to get more profitable trades using seasonality. This video is for anybody who is day trading, swing trading, and generally anybody who is trying to time the markets. This video is the first part of a two-part video series on seasonality, so please make sure you check out the second video. Also check out the information below this video for useful links. So what does Wikipedia say about seasonality? In time series data, seasonality is the presence of variations that occur at specific regular intervals less than 1 year, such as weekly, monthly, or quarterly. Seasonality may be caused by various factors, such as weather, vacation, and holidays, and consists of periodic, repetitive, and generally regular and predictable patterns in the levels of a time series. So what does this mean for traders? Well, traders, investors have been looking at patterns in the market since time immemorial. We all know sell in May and go away. We all know the Santa Claus rally. We all know the presidential cycle, all these various factors and supposed cycles that are pulling and affecting the market. If you wanted to delve more deeply into this subject, you would find a whole host more, no doubt, based on astrology, based on the cycle of the moon, and all sorts of interesting perspectives. But in this video, I'm going to be focusing on something that I consider quite a powerful force, and that is days of the month. Now, I've used the S&P 500 as a measure of the broad stock market indices, one of the most widely followed and representing a very large amount of capital, the 500 largest US listed companies. This video is in fact a follow-up to an article that I wrote 3 years ago, and there is a link on the screen and below if you would like to check out the original article. And in that I looked at the S&P 500 and I looked at the most profitable trading days over the period of 1994 all the way to that time, March 2015. Now I want to do a follow-up because as backtesters of the market, not just traders, we want to make sure our theories hold water going forward. It's no use having backtests that look amazing in the past but don't help us going forward. So in this video we're going to be looking at the 3 years, approximately 3 years that have passed since that article. To explain trading days of the month, all I am doing here is excluding weekends and holidays from our data. So on the screen is the trading days of the month from January 2000 to March 2015. And here you can see the pattern that I identified previously when I looked at the two main periods. The middle of the month period, there's a hump in the middle of the month, and there's another hump that comes in towards the end of the month and peaks at the start of the month and then dies away. So let's have a look at the data since then, from March 2015 up till February of 2019, so about 3 years worth of data. Now, of course, we're using a smaller amount of data here, so statistically, we have to expect it to be slightly less reliable just because there are fewer data points. But anyway, we can see that the data seems to hold, or the trend rather, seems to hold broadly true. We have a hump at the middle of the month and another one a little bit messier towards the end and at the very start of the month. Now, just to make this a little bit clearer, I have broken this down into 4-day periods and aggregated that. And you can see here that this slightly cleaner pair of graphs now shows quite clearly we have that strong hump in the middle of the month, and we have 2 smaller ones at the very end and the start of the month. So we can see that based on this very quick analysis, that the thesis and the pattern, the seasonality that I spotted earlier, seems to be holding true over the 3 years subsequent to this. Now let's have a look at how I have tested this theory using an actual backtest model. On the screen at the moment is a trade-informed backtest model, and I'm going to show you how I have set up the backtest. Now if I click over here on Backtest tab, you can see this model is set up in Excel, and it is a way to test all sorts of different trading strategies. And I'm going to go over some of the features here, but if you'd like more information about this, there is a link on the screen at the moment and below this video, so please check that out. Now you can see here, trading day of the month, very simple concept. We just start on literally the first trading day and we count upwards. So February we had 20 trading days. If I start here, we can see that in March we had 23. And so on. Very simple concept. We do this, as I said previously, to avoid the effect of weekends and holidays. And there is not an awful lot going on in this model. I've got some filters that I'm going to explain in the second part of this video series. But what we are doing basically is entering a trade when we hit a certain trading day of the month and exiting on another. If you remember the shape of the charts that we looked at before, where we saw the patterns of the different days, we can see that going back here to the results tab, we can see that we're entering on day 19 towards the very end of the month, and we're exiting on day 3 in the early part of the month. Now to catch that middle of the month hump, we're entering on trading day 8 and we're exiting on trading day 12. And we can see here, first of all, this is the very familiar S&P 500 index since 2000. You can see we've had the ups and downs, dot-com crash, financial crisis, and subsequent recovery. And we can see by using those trading days, we've very much minimized the effect of the dot-com crash, which at the time was a very significant and long drawn out market, bear market. And although there is still an effect from the financial crisis, it is much less pronounced than in the original data. We can see that the overall effect of this is a steady compound annual growth rate of 5.6%. Compared to the market, 3.9%, although that is over the whole time period up until today. What I'm interested in, and I say it all the time, is drawdown. We've got much, much lower drawdown, 14.8% compared to over 56%. And the problem with 56% drawdown is that most human beings who happen to be traders tend to make mistakes, tend to get angry and emotional, and quite often get out at the wrong time and fail to get back in at the right time. So we've got low drawdown. It makes it easier to trade and keeps us happier. We've got a high percentage of winning trades. This is somewhere around the percentage of winning trades, of winning, what we're talking here is roughly the number of days up. So roughly 60% of times the market is up over this time period, but we're able to capture more of the gain. So we've got better trading days in general. Now I'm sure you're interested in finding out how this theory has progressed in the 3 years since the original article. So if I push this forward to 2015 and I change this date here to 2019, we can see. Right, we can see that this bit over here, this last 3 years of trading are now shown here. And we can see that on the whole, generally, this strategy has done well. It has shown a very steady compound annual growth rate of 7.4% and a maximum drawdown of 10%, which for anybody trading in 2018 will not surprise anybody when we had the significant rise in volatility. And we can see down here the spike, how the spike in volatility affected the index. This first one in the springtime and this later and deeper one towards the end of the year. We can see that on the whole, the strategy has performed pretty solidly during that tough 2018. Now, a new feature in this model is the annual analysis. Now, this helps us to understand the compound annual growth rate and what this actually means in terms of annual results. All of us tend to think in annual performance, and we can see it here. What we've got is, for most of 2015, we had 4.1%, 1.1% in the slightly tougher market conditions of 2016. But when things really got going in 2017 with low volatility, the strategy was able to increase the capital by almost 25%. We scraped through 2018, but without seeing any of the large drawdowns that many other hedge funds and individual traders got. And 2019 has started off on the front foot, showing a 5% gain for the first couple of months. So this is a useful way to get a more realistic visualization of how the strategy has performed. If I go over here, we can have a look at some of the individual trades. We can see that we're mostly, if I scroll down here, looking at fairly small up and down trades. We've got a few percent here and there, one or two more shocking ones. End of January, we've got a large increase in volatility, but mostly this is a nice steady trading strategy. Now, in the next video in this series, I'm going to be looking at this spreadsheet in much more depth. I am going to be looking at some different scenarios. I've already programmed these scenarios in, and we can see how this trading strategy could maybe be improved, or what we can do to at least understand it on a deeper level. So if you enjoyed this video, please remember to hit the like button. Please subscribe to this channel for lots more content like this on backtesting your trading strategies, on making your trading more effective, and quantitative strategies to help you as a trader. And for more information about trading the financial markets and backtesting using Excel, please go to www.tradeinformed.com.